Good morning, everyone, and welcome to this morning's session with Schroders Personal Wealth. Before we start, just a little bit of housekeeping. Just to let you know, the session is being recorded and will be available after the event along with the slides. You'll receive our post-event email with all of these details and a link to our feedback survey. So if you could just complete that, that would be really appreciated. If you could just keep your microphones muted during the presentation. Any questions, pop them in the chat as we go along, that would be fab. So now, without further ado, I'm delighted to pass you over to Claire Bocking.
Good morning, and thank you for taking time out of your busy day to join us. A special thank you to Nicola and the team at Pro Manchester for organising this live event, which is focused on looking beyond the pandemic with an economic and investment outlook. I'm Claire Bocking, Head of Client Support at Schroders Personal Wealth based in Manchester, and I'm delighted to have with us this morning our Chief Investment Officer Marcus Brookes and Investment Specialist Natalie Tysoe. At Schroders Personal Wealth, we want to be more than just a financial planning business. We want to transform the industry and create a society where everyone sees the value of a financial plan. Money is just the fuel for the rocket. What people really want to do is go somewhere. We all have hopes, dreams, fears and aspirations, and our advisors are here to help you work out where you want to be and how to get there. And through this, our mission is to deliver more advice to more people than any other financial institution. So we have 11 regional offices. One is based in Manchester City Centre, which provides local support and advice for you and your employees. We offer free consultations and can meet you at either your local Lloyds, Halifax or Bank of Scotland branch, or at your home or office if that's more convenient. We also offer telephone and video consultations. So being in the city, we're delighted to partner with Pro Manchester and actively contribute to the SME Club and the wider Manchester business community. So what makes us different is that all our advisors are employed, which we believe removes advice bias, and we're also transparent on cost, which we feel is creating confidence for our clients. So Schroders Personal Wealth is backed by Schroders plc, one of the UK's leading fund managers, and Lloyds Banking Group, one of the UK's leading retail banks. And together we have over 400 years of experience of helping customers get where they want to be. All our advisors are highly qualified and they have professional expertise across finance and investments. So if you would like any other information on how we can help, then please do get in touch. So today's topics, firstly, Marcus is going to walk us through a global outlook, looking at COVID-19, the global recovery and also inflation. And then Natalie is going to take a look at the psychology of investing. We're then going to open up for any questions that you might have, so please don't be shy. You can submit any questions in the chat facility throughout the presentation, and we'll come back to them after the presentation. So I'll now hand over to Marcus. Thank you.
Thanks very much, Claire, and good morning to everyone. As Claire said, I'm going to take us through a global economic outlook, a little bit of crystal ball gazing, and along the way we're going to try and do a couple of polls. Now this is relatively new to me, so please bear with me if I get this slightly wrong. We're going to ask you some pretty simple questions and give you all the answers straight away afterwards. So hopefully you'll enjoy this. And as Claire said, please do give us some questions. We try to do a good stab at forecasting what it is you might be interested in, and there's every chance we've got it wrong. So if there's a question that we've failed to cover for you, please feel free to come forward with it, and look forward to helping you with that. So if we move on to the first slide, please. So here we are. I'm just going to give you a quick overview of where we've come from before we start talking about the future. Now, you need to be living under a rock not to realize that COVID had quite a significant impact on stock markets and other markets around the world. And if you look at the left-hand side of this chart that's on the screen, you'll see that all four of those colors, each color of those lines represents a different market. So the more sort of purpley coloured one is the FTSE All World Emerging Asia Pacific, so stocks such as Samsung, for instance. The yellow line is basically all the developed world, so that would include what we would think of being the US, Europe, Japan and UK, for instance. The very dark line is Latin America, which, as I'm sure you're aware, is having a pretty torrid time still with COVID. And then we've got the orange line, which is just European indices. So, you know, things like BMW, Electrolux and stocks like that would be in those indices. If you look at the axis on the left-hand side, the y-axis, you'll note that we've labeled it total return. It's actually really an index return, and we've started them all at 100, okay? So any deviation away from 100, you should think of as a percentage. Now, if it goes up by 5, you've made 5%. If it goes down by 5, i.e. it's gone from 100 to 95, you have lost 5%. So as you can see, as we came into 2020, it looked like the world was looking at like a fairly benign place. And then all of a sudden, this dreadful virus and the news of it really got out. And as usual, financial markets decided to shoot first and ask questions second. So investors around the world withdrew their assets from what they perceived to be risky assets, investing in companies that whose valuations are supported by profits. And if COVID means that people aren't shopping anymore, then those profits are very likely to go down. And so you'll see a fairly precipitous fall in all 4 of those areas. There wasn't an area that you could have gone to that would have really helped you make money. It was really a matter of losing the least money. Now, what I think happened here is that, as I say, people shop first, ask questions second. But then we've seen a pretty decent recovery from the bottom of the market, which was in April 2020. And actually from peak to trough, you've made money in 2 out of the 4 markets. And actually, sorry, what am I saying? It's more like all 4 of them have now made money over this period as a whole, over the was it 15 or 16 months. So what happened? Why was it that even though the COVID pandemic was still ongoing, that financial markets actually started recovering? Because it's not necessarily intuitive to outside investors. Well, to be frank, what happened is I think this is an outcome from 2008. It seems like an odd thing to say, but in 2008, in the financial crisis, you'll recall that quite a few financial institutions came under very strong pressure from financial markets and the conditions, subprime in effect. And the authorities failed to act in time. And I think that's the key takeaway from 2008. So what we saw was Bear Stearns got into very strong trouble, and it got taken over by JP Morgan. Lehman was also under extraordinary stress, but they didn't move quickly enough. So Lehman actually went bust. And there was a cascade effect as a result of that one bank going under, because everyone that had a relationship with that bank suddenly didn't know where the money was. Now, this time, rather than waiting for something to go wrong first before reacting with the bazookas of cutting interest rates and cutting taxes and having furlough schemes and so forth, the central banks and the governments around the world moved very quickly to contain the problem as quickly as they could do. They were aware that if there was mass unemployment and you told people to stay at home, you'd end up with civil disorder, and the problem would only get worse and worse and worse. So what we've seen is incredible amounts of stimulus, and that gave investors the view that maybe profitability today wouldn't be fantastic, but in the years to come, actually the companies would survive, and therefore the jobs that at those companies would also survive. So that's why I think that we can say that there's been a pretty decent recovery, even though for much of this period, the COVID situation was getting worse, not better. So we go to the next slide. So the first poll, I'm looking at my colleagues here to bring this up, but you'll be able to interact with this poll in just a second, I hope. So given what I've just said, what's the best performing asset class year to date? So from 2020, the 1st of January 2021, sorry, to the end of May, which has been the best asset class? Is it global equities? Is it UK equities? Is it commodities such as oil and gold and agricultural? Or is it global government bonds? Hopefully this will be popping up now. And there we go. So if you'd like to put in your selection, again, an early view of what people are voting for. Commodities seems to be very popular. Global equities, also very popular. Looks like we might be stabilizing. Oh no, a couple more votes have just come in. Okay, I think we'll end the poll there. And it's fairly evenly split. So as you can see, when I share the results, if the technology works, there's a tie for first place between global equities and commodities. UK equities was seen as a laggard alongside global government bonds, which is, I think, a very interesting outcome from that poll. Thank you. So if we move to the next slide, we'll see what it actually was. So the year so far, what has done well? Well, congratulations to everyone that said commodities. You're absolutely correct. The commodity index, or the index of all the commodities that we've been using, which is the Bloomberg Commodity Index here, is up 18.9% year to date. Fantastic. And many of you will probably realize that the cost of petrol at the pump has gone up, and that's largely as a result of the oil price recovering. There was a very brief moment in time when the oil price went negative because there was so much of the stuff sloshing around. No one wanted to buy it because it costs you money to store it. In terms of the despondency on UK versus global, actually the UK is holding up quite well. And it's been a feature of this year that UK shares, which have been unloved ever since the Brexit referendum in 2016, they've massively underperformed the US, for instance. They're actually doing pretty well year to date. We're starting to see overseas investors come to the UK and actually just buy the entire company. So there's quite a bit of M&A going on in this space. For those that thought the government bonds had done well, I'm afraid you may need to look at your portfolios. They've actually had a bit of a struggle, and we'll come on to why that might be in just a little moment. So we go to the next slide, please. So COVID, how are the countries coping? There's different ways of measuring this, and this is something we've taken from one of our investment manager at Schroders, who've been looking at Johns Hopkins, who've been a fantastic database of measuring how various countries are doing. Each one of these colours represents a country. So the yellow, for instance, Italy. You can see the COVID cases peaked in Italy in around about mid-November. That very light blue is the US, and you'll recall that the previous president was, should we say, not as on top of the situation as the new incumbent, and how that light blue line has really, really come down. It has been fantastic. And if you've got friends and relatives in the US, as I do, you'll know that they are, having started way behind the UK, they're actually accelerating past us in their vaccination program. The dark blue line there, France, is clearly showing some still ongoing issues, and we'll come on to that in just a moment, but it's not very nice to see that the UK is leading the way with that black line. Not a great pandemic. The excess deaths numbers, I think, will be something that people will reflect on in the years to come, but in terms of the vaccination program, I think we can actually say well done, and it's world class. We move to the next slide, please. So the vaccine rollout, I think this is the key to financial market performance from this point in. And I would say if I was talking about this 3 months ago, people may have been somewhat skeptical about the efficacy of the vaccines, and also people's willingness to take them. I think we now have 3 or 4 months more data, and actually we can see that some of the naysayers may prove to be incorrect. So when we look at the left-hand chart, the dark blue represents that proportion of the population that's had at least one dose, and the yellow bit includes those that are fully vaccinated. And you can see that the UK is leading the way, United States just on our coattails, but I would suspect, given the plans that the US has come out with, that they'll be spinning past us fairly soon. It's amazing how Spain, Italy, Germany and France have got broadly the same outcomes. They, of course, are part of the EU. They, of course, have signed up to the same program, and therefore one mistake led to many mistakes. So I think they are now trying to catch up. If we look outside of Europe and the US, on the right-hand side, the island state of Singapore, so often promoted as a fantastic place, had a very good COVID. Actually, in terms of vaccination, they're way behind the US and the UK, but still ongoing. Brazil and India, and the data out of India, I think we need to treat with some suspicion. But it looks like there is some vaccination going on there, but not enough, in our opinion. So the Western world seems to be increasingly on top of it. The Eastern world and the developing world needs a little bit more of an impetus, I think, really to get very excited about what they're up to. Can we move to the next slide, please? So this is a survey taken back in last December, and it sort of reflects on what I was saying just a moment ago. And it was a survey that asked people in each of these countries on the left-hand side, if a vaccine for COVID-19 were available, would you get it? And the dark green represents those that actually really would. Very, very keen to get the vaccine. The light green represents those that are quite keen to get the vaccine. In other words, optimistic about it, but slightly worried. The pink colour was those that would really actively not want to get it because they have some concerns, probably could be persuaded, but are on a slightly negative bias. And the red ones are the ones that are completely skeptical. So if you look at the top, China, 27% of the Chinese population would actually take the vaccine, 53% probably would take it. So that's about 80% in total, with only 20% of those in doubt. If you look across it, it's pretty consistent, apart from right down at the bottom. And here we have France, where only 12% say they would definitely take it. 28% probably would take it. In other words, 40% of the French population would take the vaccine, with, in other words, 60% saying that they wouldn't. And that, I think, is partly to do with the European response to vaccines. It's not only that they may not have secured enough supplies, it may well be that some of the population still retains some concern about the efficacy and the health benefits of these vaccines. Please don't think I'm making any political statements, I'm just citing a survey. If we move to the next slide, please. So assuming that we've got the vaccine program okay, that the vaccine program is starting to flatten those COVID curves, that we're starting to see populations becoming more optimistic, and also that governments and central banks had done enormous stimulus plans, why are we still optimistic that there's even more growth to go? Because all that's known. Well, it's because actually the stimulus isn't stopping. The latest is Mr. Biden's plan. It's a $2.3 trillion proposal. And when you look at the elements of it, it's not just a tax cut. It's not just making wealthy people more wealthy, as other tax cuts from previous incumbents have done. This one's actually going to go into concrete and bridges and hospitals and telecommunications. So for instance, there's 100 billion going into high-speed broadband. It's amazing to think that we all look at America as being the leader in technology, particularly with Silicon Valley, but actually the infrastructure that supports that entrepreneurialism isn't really there, hasn't been invested for quite some time. And look at the elder and disability care, 400 billion. You know, you can probably come to the conclusion that Mr. Biden for infrastructure. If you've been to America, if you've been to the airports and you've seen the roads, you know, this is something that really does need to be invested in. So if we go to the next slide, please. So 2.3 trillion, I'll put 2.5 up here, is a very big number. Almost too big for most people to really conceive. So we found this graphic on the internet and we've pinched it and put it into our presentation. If you look at the person on the top left, that is a person looking at a stack of $100 bills that represents, in proportion of his size, what that stack of $1 million would look like in $100 bills. The one to the right of him is $100 million in $100 bills. And the one to the right of that, and you can see there's two rows of 5 pallets, which would be just 1 billion. And for those that can't remember their school maths, a trillion is 1,000 billion. It's the American version. If you're as old as I am, it used to be just a billion, but now it's 1,000 billion. And that is the diagram at the bottom. You can see the size of that person and how many rows and how many stacks, and that's just 1 trillion. We need 2.3 times that to really get to understand the size of this stimulus plan. And given that there are 330 odd million people in America, this is a very real, huge stimulus plan on top of all the stuff that was done way back in 2020 when this first announced. So why do we think that markets still have some way to go? If you put this much fuel onto the fire, it's likely to burn more brightly. So if we move to the next slide, please. So are we still happy that the vaccine's having its intended consequences? Normally, we would be using economic data. We'd be looking at surveys. Surveys take a while to compile. They then have all the data cleaned. And finally, about 6 weeks after the data point, you get to see what's going on. It's far better, we think, to use some of this mobility data from people like Google, who they track your phones. They anonymize your data, but they track your phones. They can see who's moving around and how often. And you can see the Google mobility data here from 2020 into 2021. The 18th of February and 28th of February data points, you can see were negative. In other words, people were doing an awful lot less in France and Spain and Germany and UK, Italy and the United States. And then we saw a really big pickup this year. And if you look at Spain, for instance, in April, activity really went through the roof. So we can see that some confidence is happening, economies are opening, there's evidence that there's activity going on. That would normally lead you to believe that the economy is going to do well. And if you look on the right-hand side, this is about retail and recreation. So the other one was about workplace, people going to work. On the right-hand side, this is people going to shopping malls and buying stuff. And you can see again, people are spending money. And to use a hackneyed old phrase I've used for many years, which is one man's spending is another man's income. If people go out and they spend money, the person that has sold them something has made a profit, and they then pay their suppliers, who then need to pay their suppliers. And you can see £1 keeps on going through the economy and creates an awful lot of GDP. So yes, we're happy that activity is going up. If we look at the next slide, please. So what does that mean for economic forecasts? Well, they too have been more optimistic as a result. If you look across the Eurozone, which has had not a great COVID and not a great vaccine outcome, we are still upgrading the growth here because we can see the trends are positive. They're behind other areas, but they're really starting to pick up. These are not massive upgrades. You can see Italy was upgraded from 4.1% forecast for 2021 to 4.5%. But compared to what happened last year when it was down 8.9%, Spain was down 10.8%, the UK was down almost 10%. The bounce back in 2021, which we're very pleased to see also continues into 2022, means that we're confident that financial markets will be in a good place to benefit from this positive economic growth. So we move to the next slide, please. So our second poll. So we do use an awful lot of survey data. We ask people their opinions. It's much better to get the wisdom of crowds. And the latest fund manager survey that was done of institutional investors around the world was actually put together by Bank of America Merrill Lynch. They were asked, what's the current biggest risk to investors? So the question to you is, what is the current biggest risk to investors? Is it higher taxes, higher than expected inflation, greater regulation, or a threat to COVID-19 vaccine rollout? Now we've got the old poll up there. Does that mean I need to, oh no, here it is. So if you'd like to start making your votes, please. Got an early runner in higher than expected inflation, followed by COVID-19 vaccine rollout. Higher taxes is popping up a little bit. No one thinks greater regulation. Interesting. It's just beginning to settle down now. Okay, get your last votes in, please, before I end the poll. I think we're stable there. Great. Well, I'm going to share the results with you. And I'm very pleased that you're obviously all reading the same sort of investment research that I'm reading. That higher than expected inflation is now the #1 threat to investment markets. And we'll come on to why that might be the case in just a moment. But well done. I do think higher taxes is going to be an issue. So the 21% of you who put that down, I think you're absolutely right. I just think that's probably going to be a 2023 thing. They're not going to imperil the recovery by raising taxes too soon. And the COVID-19 vaccine rollout, the five people, the 17% that went for that, I'm kind of with you on that actually, because we've all now got very, very comfortable with the fact that the vaccine not only will do what it's intended to, but that people will adopt it. And until the world's got it, maybe we're being a bit too comfortable about that. So, right, I think we need to go to the next slide, please. So there's the data. If there's two different data points here, or two different periods. The very darker purple was February 21, and you can see that the main concern back in February 2021 was the COVID-19 vaccine rollout. That has now massively receded in the March data. As you can see, it's more than halved. And as that optimism about the economy opening up has happened, then there's every chance that the governments and central banks around the world have overstimulated the economy, and that we could get traction sooner. And that could lead to things like supply issues. So having the wrong stuff in the wrong place. Everyone wants to buy garden furniture in the UK, I understand. But the issue is that because the pubs could only offer their services outside, they bought the limited supply that was in the UK. And now, because containers around the world are in the wrong place because logistics broke down, we're now seeing evidence of inflation everywhere. The question I think for markets is this temporary because it's just a bit of a block because of what happened in 2020, or is this permanent? So have we been through a period of deflation that needs to end? And you can see the second risk is the tantrum in bond market. And what that basically means is if we've got inflation that's not expected, then bonds are the wrong price. And there could be a tantrum where investors just sell, as they normally do, sell first and ask questions later. So well done to those that voted for that. If we go to the next slide, please. So is there any evidence that inflation is coming through? Well, the blue line here is CPI core. So it's all the stuff that you can't avoid. That actually looks like it's going down, or it certainly went down. Whereas CPI year on year is actually picking up. So that's a more instantaneous data point, the green line. So the green line would suggest actually there is some inflation issue here, still below 2% officially. But if you ask anyone in the construction industry what they're having to pay for cement and for timber, you know, it's more like 20, 30, 40% if you can get your hands on it. So I think inflation is certainly something we need to worry about for the shorter term, looking for more evidence if this is going to be a longer term issue. We move to the next slide, please. So in summary, and I've taken way too much time, I apologize for that. The current outlook is that demand for that you and I have got as private citizens has been delayed, not destroyed. We wanted to go on holiday last year, we couldn't do it. If you're someone like me who's just had their 50th birthday, I wanted to have a big party, I wasn't allowed to have one, I'm still going to have one. It's just been delayed. So we're going to spend that money that we always intended on spending. Vaccines are the game changer, but let's make sure that we're absolutely sure that the efficacy is what we expect it to be and that it gets spread everywhere. And inflation risk does remain, but interest rates are likely to remain low. I think it's more likely central banks and governments will allow rates to stay lower for longer because inflation was lower than they expected for a much longer period. So I think they'll allow an overshoot. And if you listen to Mr. Powell of the Federal Reserve, he's basically said that out loud several times. So assuming the vaccines are okay, then this could be a year of two halves. So economic growth will pick up, already is, we'll show you the data, and we expect that to accelerate at the end of 2021 and into 2022. Therefore, profits should be fine. Risky assets are probably more favorable than bonds, but if you're going to be in bonds, perhaps corporate bonds are the place to go. And we're optimistic for returns for 2020 as a whole. Anyway, thank you very much for your interest. I hope that's been interesting, and please get those questions in. And I'd now like to hand over to Natalie Tysoe, one of my colleagues, to talk about the psychology of investing. Many thanks.
Great, thank you very much, Marcus, and good morning, everyone. I hope you're all well. As a way of introduction, like Claire and Marcus said, my name is Natalie Tysoe, and I work as an investment specialist based in Edinburgh within the investment office of Schroders Personal Wealth. So for the next 15 minutes or so, I'm going to talk about the psychology of investing, including some things to consider when investing, as well as our approach to investing. As Marcus and Claire said, if you can think of any questions as I go through, please do post them in the chat function and we'll answer as many as possible at the end. So to start with then, I'm going to pick up where Marcus left off in the discussion regarding inflation. Now, one of the main reasons why people invest is to keep pace with inflation, which, as you'll know, is a measure of the trend in rise in prices, and CPI, or Consumer Prices Index, is a measure of inflation which looks at around 700 goods and services to see how the cost of living changes. Now, the impact of inflation over time can be huge. We just actually need to look at house prices as an example of a type of inflation. So what a lot of investors want to do is ensure their savings keep pace with inflation so that when they do come to spend that money, they can still buy what they wanted to. Now, as Marcus said, central banks like the Bank of England tend to target an inflation of around 2% because a relatively small but steady rise in prices is a good thing. And what you don't want is deflation, because if something will be cheaper tomorrow, people tend to put off buying, and that kind of exacerbates the problem. To put this into context then, we can look at this example. If we work on the basis of 0.4% interest rate on cash savings, which was the average rate about this time last year, and actually I think that you'd be hard pressed to find an account paying that now, and also an inflation rate of 2%, as I said, central banks tend to target this amount. But 2%, it can be a lot higher than 2%, as we have seen in the past. Each year then, inflation reduces returns by about 1.6%. So in monetary terms, that would make, for example, £100,000 become £98,400 in terms of spending power. Now, what I mean by that is the actual amount you see in your account would remain the same plus interest, but what you can purchase with that money reduces. So if you have your eye on a new car or savings more generally, those savings need to work harder to ensure you can make those purchases going forward. So inflation is important when considering investments, especially when interest rates on cash deposit is so small, because the real value of money will be eroded over time if inflation outpaces return. So to put this into context over the longer term then, we'll use the same example of £100,000, 0.4% interest and inflation of 2% per year. Therefore, erosion of spending power will be 1.6% per year. And if we look at after 10 years, say, that £100,000 will be able to buy you £86,000 worth of goods, assuming those figures on the right hand side. But actually over 25 years, which isn't an unrealistic amount of time if we're looking at retirement savings, for example, it would lose about 1/3 of its spending power, so down to £66,000. Now, every investment has its risks, and cash is no different, primarily because of inflation, which is what I term the invisible risk, because savers don't tend to realise until it's too late, but it's gradually there, chipping away at spending power. That's why a lot of people invest to grow their money, beat inflation and interest rates on cash, and over the longer term this has proved to be the case when invested in a well-diversified portfolio of investments. So let me explain what I mean by that. Now, what is important to remember with investments is that different asset classes react differently to the same event. Therefore, when investing, it's really important to spread your money across different types of investments, different countries, different regions, and even different industries. By having a diverse range of investments, we can reduce total portfolio risk in order to smooth out returns over the longer term. Now, the current environment highlights this point because COVID-19 was an unpredictable event in terms of its scale and impact on financial markets. Therefore, it's really important to have portfolios that are already diversified to cope with these types of events. Now, to exemplify this point further, I would take you through what we call the patchwork quilt, as you can see on your slides now. Now, although this slide has a lot of numbers on it, it really just highlights the term of not putting all your eggs in one basket. It looks at returns of different asset classes over the last 12 years, with the colours representing the ranking from best to worst. Now, we'll see that year on year, no one asset class performs the best or consistently. And that's why we think it's a good idea to spread your savings and investments, such as pensions or investment funds, across different assets because they tend to perform differently to the same event. Now, if we just on this slide take 2010 and 2011 as an example, world equity in 2010 grew by nearly 16%. I think anybody would be pretty happy with a one-year return of 16%. But the following year, it was down 5% in 2011. So actually in 2011, you'd be pretty happy if you're invested in gilts, which are UK government bonds, up 16%. So it's all about having that spread to ensure that you can participate in returns of different asset classes and also have some of that downside protection in more of defensive assets and also participate in the more riskier assets when markets are going up. And actually, if we look at the bottom row of this slide, we can see that cash returns over the past 12 years. Now, cash has been in the bottom 2 in terms of worst performing half the time, so 6 out of the 12 times, and it has never been in the top 2 performing asset classes. In fact, in the past 12 years, cash has only generated more than 1% in one of those years. And that's where the topic of inflation really comes in, because to keep pace with inflation, assets, including cash, would need to grow by around 3% over the past 12 years. You'd be pretty hard pressed to find a cash account that pays more than 0.1% at the moment. So there is no way that cash can retain its purchasing power, certainly not at the moment. And this issue isn't going away. So moving on then, one thing that is demonstrated amongst investors time and time again is what we call the roller coaster of investor emotions. Now, you've probably seen this chart in many different guises before. But when I was talking to clients back in February and March last year, some of the reactions were textbook to this chart. Now, the economy and markets work in cycles, and when they are moving up, that's when we start to see more optimism and excitement. You know, people talking to their friends, saying how well their investments are doing, and everyone wants a piece of the success and think, you know, what could possibly go wrong? Well, invariably markets will fall again, and with lots of people investing when markets are going up, we reach the point of maximum financial risk because investors are buying at a height. Now, when markets start to retract, that's when anxiety and fear kicks in, and people who invested without the knowledge of how markets work, or perhaps not invested in the most efficient way, start to question their decisions. Maybe markets just aren't for me. However, the correct response is, this is a temporary setback. I'm a long-term investor, and markets will reach the bottom, which is the point of maximum financial opportunity, and the whole cycle starts again. Now, the unfortunate reality is that nobody knows when the bottom has been reached, or the top has been reached for that matter. But what we do know is that over the longer term, a well-diversified portfolio, investors can see good positive returns on their investment. And actually, we can smooth out the ups and downs by constructing the portfolio in a way that benefits when markets are going up, but also some downside protection when things aren't going so well. For example, the onset of a pandemic. So be mindful of this type of reaction when markets are rocky, as I've seen it time and time again. So for the final poll, and before I use an example of what investors what will happen if investors do try and time the market, I thought I'd put it to you. So the final poll then is: an investment in the FTSE All-Share, which is a UK index fund, would have risen by 146% between December 2000 and December 2020, so over a 20-year time period. But how much would the investment be worth if you've missed the best 30 days? So the best 30 days in that 20-year time period has been missed. So instead of 146% return, what is the return that you're getting? So the 4 options are there, and hopefully we'll see the poll coming up any moment. Okay, first few votes are in. So 28.1% is winning at the moment. Give you a few more seconds before I end the polling. Right, I'll end the polling there. And if I share the results, hopefully you can see now. So lots of optimism. So instead of 146%, people are thinking if you've missed the best 30 days, you would be looking at an investment of a return around 28.1%. Some people then saying minus 3.1%, only 11% saying minus 26.3%, and only 4% saying minus 41%. So actually you're very optimistic in terms of this poll. So if I stop sharing the results, close that down, you should be able to see on the next slide that the answer was actually minus 41%. So I don't think many of you got that right. Lots more optimism, but let me just explain why. Now, importantly, no investor in history has actually been able to time the market consistently. Nobody knows what Trump will tweet next to move the market, or at least when he was president, or when Elon Musk, what Elon Musk is going to say next. So the point is that moving in and out of markets, trying to time the highs and lows, is pretty much impossible. So as you can see on this slide, this is some of the worst case scenarios based on the concept of trying to time the market. Now, as I said in the poll, we're using the FTSE All-Share as an example, which is the UK stock market, and in a 20-year period from the year 2000 to the year 2020, or the end of, the index, like I said, has risen by 146%. But by missing the best 30 days, the index would have instead fallen by 41%. So just bear that in mind if you're trying to kind of move in and out the markets. Now, also bear in mind that this is an extreme example, because missing the best 30 days in a 20-year time period will be pretty unlucky, but it does highlight the potential impact of moving in and out of investments. Now, overall, we believe that its time in the market is better than trying to time the market. And what I mean by this is that there are often significant recoveries after falls, as we've seen in the COVID-19 pandemic, and it's often hard to predict when markets will recover. So unless you have a crystal ball, and I certainly don't, it's best to take a long-term view and remain invested through these periods of uncertainty. Now, what I've talked about so far are really important points when considering investing, which is why it's no wonder that some of them form the foundations of our investment approach. So as you can see on this slide, our investment approach is based on 5 guiding principles that we use when making investment decisions. The first one then is understanding risk and return. Every investment has associated risks, but it's about understanding the potential return that compensates you for taking on that level of risk. This is both from a client point of view, which is why we have various different risk profiles, matching up to the client's attitude and capacity towards risk, and an investment point of view. The second one then is focusing on the longer term. So as I already mentioned, the majority of our decision making will be based on our long-term view. We are not aiming to shoot the lights out overnight, but incorporate in-depth analysis in the way we build our portfolios with the aim of achieving real growth over the longer term. For example, we could look at government initiatives that will drive long-term growth in certain regions and sectors, or trends that are impacting markets, and really filter out the market noise, which often causes short-term fluctuations in markets. The third one then is maximising short-term opportunities. Now, while the majority of our investment decisions are based on our long-term view, we can maximise short-term opportunities, whether that be to enhance returns, manage risk, or both. The fourth one then is utilising specialist expertise. Now, this is where Schroders Investment Management multi-manager team really come in terms of scouring the market of 5,000 or so managers and funds to select the best ones to run the mandates we have chosen. Now, no one investment manager can deliver the best return or the best outcome all the time. Therefore, we use a range of different investment managers across the fund management industry. It also helps to have expertise in an area that you're investing. For example, our Japanese equity manager has analysts based in Tokyo so that they can, meet with the company directors, they speak the language, they know the culture and local country and industry changes to really give them an in-depth understanding of what companies will outperform over the longer term. And finally then, to hold a broad spread of investments. Now, this is the point that I was making of not putting all your eggs in one basket, which I explained with our patchwork quilt. With that, I will end by showing you some of the historical performance of one of SPW's products. There are 6 different risk profiles available depending on how much risk you want to take on, and also considering your financial position. And as you can see, all 6 risk profiles, from high risk, which is adventurous, to low risk, which is named as cautious, have comfortably beaten cash and inflation over the longer term. So I really hope that's been a useful summary of some of the conditions or considerations around investing. Marcus and I would now like to take your questions, so I'll hand back to Claire for that.
Thanks very much, Natalie. That was really insightful. Thank you to you both. And thank you to everyone on the call. We've had some great questions in already. So the first question is for Marcus. It's from Mustafa. And the question is, where do you see inflation in the end of 2021 and 2022? And the same question for interest rates and the FTSE.
Okay, well, I'm assuming that Mustafa, having referenced the FTSE, was talking about UK inflation rather than global. But yeah, I've got the consensus data here, and I will just say, I'm going to read out some numbers now, but I think our numbers are slightly higher. So if we look at CPI, which is not core CPI, it's all the CPI measures. In 2020, CPI was 0.9. In 2021, it was 1.6 is the forecast, sorry, I should say. And in 2022, we're looking for that to be around about 1.9, and same in 2023. So given the amount of stimulus in the UK economy, given the amount of stimulus in the US economy and elsewhere, I think people may be putting in numbers slightly north of that. And certainly that's our current thinking. But from the consensus point of view, it looks like the low inflation period of 2020 we will have seen the back of this. I do think, though, that there's a chance that we get some sort of, I don't think we should write off the chance that we'd have some sort of slowdown where there's an unanticipated shock that comes through. But anyway, that's the inflation forecast. And just to put that into context of bonds, the UK 10-year government bond, which is the benchmark bond, it's the most liquid, it's the one that everybody tends to invest in. Back in 2020, that was yielding 0.25% per annum each year for 10 years. So way below inflation back in 2020, so you get a negative real return. The forecast for the end of 2021 is 0.9. and for the end of 2022 is 1.25, and the same for 2023. So as those yields are going out, that would imply that the price of those bonds is going down, and hence why you'll see a lot of investors selling out of their very safe, very sensible government bonds that have probably done the job for their portfolios in 2020 and are less good for 2021. Base rates, the view there is that they don't change. As I said during the presentation, that we think that because central banks have observed inflation being incredibly low for much longer than they anticipated, even with the advent of QE and other measures they undertook, that they're going to allow rates to stay low, and the consensus forecast is 0.1, where we are currently, doesn't change out to 2023. So it's almost like they're encouraging or stoking an inflation concern, which again is likely to lead to some sort of bond market tantrum, and we're seeing that year to date. Unemployment in the UK was at 4.5 in 2020. We've got it going up slightly in 2021 as the end of the furlough schemes happen, and because of things being in the wrong place and all that sort of stuff. In 2022, the unemployment rate picks up a little bit again, 5.7, but then in 2023, the benefits of all the stimulus will come through and we'll see it drop down to 4.8, which isn't quite full employment, but actually doesn't feel too bad for the UK. In terms of where the FTSE is going to be, who knows? Higher, I would hope. Don't really go into index levels and forecasting that, so much could happen. But I do think that the UK stock market, having underperformed for almost 5 years now, is looking very good value, and that's why we're seeing so many private equity companies come to the UK and just buy the entire company rather than taking a stake. So hopefully that's helpful. Come back with another question if I've missed anything out.
Great, thank you, Marcus. And the next question for, I think, Natalie. So you mentioned you can take advantage of short-term opportunities. Where are you currently finding these opportunities?
Yeah, really good question. So as Marcus said, there's a lot of opportunities in the market at the moment, and in terms of taking short-term opportunities, we can be really dynamic in our approach depending on trends that are happening. So one of the things that we have at the moment within the portfolios is a positive view on Taiwanese equities. Now, this is all to do with kind of chips being very much in high demand in the world. And Taiwan has two very big companies that are huge chip manufacturers. So that won't just help those two companies, but it also helps the Taiwanese economy as a whole in terms of job creation, that kind of thing. So we think that trend it's with us and it's going to last a little bit longer. So that's why we've taken a position within Taiwanese equities to benefit from that kind of trend in chip manufacturers, electronic batteries, that kind of thing, in terms of the move to electronic vehicles and that kind of thing. So that's one of them. I think the second one, kind of moving out of equities, would probably be what Marcus mentioned previously in terms of bonds. So the bond sector is absolutely huge. So we've got two kind of bulky sectors within that. You've got corporate bonds, so lending to companies, and you've also got government bonds. Now, as Marcus said, government bond, the yield which you get in terms of a return isn't exactly high. And actually, when you incorporate inflation, although it's low at the moment, you're actually looking at not a very good return when you incorporate those two things. So actually, we've turned to more corporate bonds. So company issued debt, which, as long as we stay in the lower risk end, so investment grade is what it's called, company debt, then we think that we can get a better return on that kind of within the bond sector, and actually still have some of that downside protection, which is essentially what the bond element of the portfolio is for. So hopefully that gives you a few points. If you need any more on that, do please fire in some questions.
Great, thank you, Natalie. Okay, so the next question has come from Stephen, and Stephen would like to know, what is the view on cryptocurrency investment for the next 5 years?
Shall I have a crack at that, Natalie?
Go for it.
The real answer is, who knows? I like the fact that you use the word investment in your sentence. So I suspect that means that you're a fan, Stephen. I'm not currently. I don't see how this could be something that governments around the world would allow to persist. If you're allowing people who kidnap people and deal drugs to basically move money around the world economy without it being traced, it's not something that I would think that the governments would want to happen. So I view it currently as a speculation. I think it's something you've already seen. The US last week made a very big deal out of the fact they're looking to try and regulate it. I think the bulls on cryptocurrency took that as a view of, and they're going to find a way to make it legal, and therefore we should be more bullish. And that may well prove to be true. I would just argue that some of the coins that are out there have unlimited supplies. The original attractiveness of Bitcoin was that it was only ever going to be 29 million. And so if you were a hawk about the levels of money that was being printed by the various governments around the world, and they've done an enormous amount, I have no problem with that sort of criticism, then owning an asset where there is a limited supply, such as a Bitcoin, I think makes an awful lot of sense. But what is the value of the Bitcoin? Whenever people talk about it, they always convert that into dollars. So there's always a reference currency. It's not viewed as a currency in its own right. You can't, well, you can go and buy a pizza in various places in California, but typically you can't walk to the Horsham High Street, my nearest town, and use a Bitcoin to go and buy anything that is of any use, to me at least anyway. So Bitcoin as a currency, I think still needs to be proved. I think some of the things that the genius that is Elon Musk has been promoting, where there are unlimited supply of these coins, could prove to be not an investment at all, and they could prove to be a pure speculation. I do think the technology behind it, and I think this is consensus view, so I don't think I'm telling you anything you don't know, but the distributed ledger technology could be phenomenally interesting in terms of proving that you have ownership of something because it's on everyone's PC in the world or on the distributed ledger. This is the best way of thinking about it, would be fantastic. So just think about legal contracts. We've seen the rise of non-fungible tokens, and that's hit the art world most recently with Beeple selling an image for millions of dollars. I forget the number now, was it something like $60 million, the first NFT. And that, whoever owns that now, it can never be in any doubt that they own it, because it's everywhere. So if you have one contract, you only need to forge one contract. If there are literally millions of contracts, which is what the distributed ledger technology allows you to do, then you'd have to change it in multiple locations and break through some of the most encrypted technology out there. So not a fan of Bitcoin yet. Happy to be proved wrong in the future. Some of those I think are pure speculation, but I think the technology behind it, which will allow us to buy and sell houses, to have fractional ownership of an office block and prove title to various things that we want to own, I think that's the real winner.
Great, thank you, Marcus. That's fantastic. So next question then. So from John, much has been made of the death of the 60-40 split portfolio. What's your view?
Do you want me to start on that, Marcus?
Yeah, you go for that one.
So I think what John's meaning by the 60-40 is kind of 60% equities, 40% bonds. And I think that when we look at different asset classes that we can invest in, there are lots more available. So absolute return, you've got property, commodities, as we talked about earlier. And also within the equity market, there is such huge disparity, especially at the moment, in terms of which regions are doing well, as Marcus showed on his first slide in terms of the navigating the pandemic slide. So in terms of that then as well, when you actually dig down into the equity market, you've got what we call kind of growth versus value. So growth funds are kind of out and out, example would be technology fund companies that are doing really well. Value companies are those that have been oversold because of the sector that they're in, for example. And the disparity between those two distinctive groups in terms of growth and value has been absolutely huge. So you can, say, 60-40, 60% in equity, but actually the question should be now, okay, well, where within the equity market are you going to get the better opportunities from? Because there is such huge disparity in the market that there is definitely opportunities in some areas, and therefore you can, I guess, increase or potentially increase your returns by investing in those areas that haven't done so well within the past kind of 12 to 18 months. And also when you look at the bond industry, as I've spoken about in the previous question, it's absolutely huge, and there are so many different areas to invest in terms of where within that bond sector, also taking positions that can benefit in terms of an interest rate move, that kind of thing. So it's not just kind of a strict or a distinct, equity versus bonds, and also the other asset classes that you can invest in. So UK property, we don't have any exposure to at the moment because of the trends that have been going on, and I could probably talk about for the next half an hour about that, but I won't. But what you can do is maybe invest in global property. So we essentially invest in companies that invest in property, so much more liquid in terms of the actual asset class there, and then also kind of commodities, which you can get exposure from as well. So I think that in terms of the 60-40 model, it's probably more of the kind of old school traditional sense. And actually, when you look inside those asset classes, as well as the other asset classes that are available, that's how you can build, like I was explaining, a well-diversified portfolio, so you can benefit from these different asset classes and also have that downside protection in different guises, not just in bonds.
Lovely, thank you, Natalie. Okay, so we've got two questions that are kind of linked. So Mustafa's just sent the question through about what's the long-term perspective on all this stimulus, often referred to as MMT or helicopter money, and that's kind of linked to when and how will the government look to recoup this huge amount of spending they've made during the pandemic?
I'll go if I may. So when will they look to recoup the money that they've spent? Only when they're absolutely certain that the global economy looks like it's in a fairly secure place. And I can't see that being for some years yet. In fact, Mr. Biden, when he announced his package, referenced the fact that today's spending could be seen as stealing from the future of our children and our grandchildren, because effectively that's what you're doing. So you're borrowing money that other people then end up having to repay. And he did make it clear that he expected the repayment of these debts to happen in this generation. So 2.3 trillion spending that he outlined, he did suggest that there will be measures in the next 2 to 3 years that would see that money start to pay back. So I think we can kind of trust him on this, if we can trust any politicians. But I think we can trust that that sounds like a sensible approach. In terms of Mustafa's question on MMT or helicopter money, MMT is known as modern monetary theory. Other people who are not so keen on it, people like me, call it the magic money tree. And helicopter money refers to an economic theory of flying a helicopter over a city and just throwing notes out of the door so that people actually get the money in their hands and they actually go and spend it. A lot of stimulus programs in the past have been via tax cuts, and only people who actually pay tax get the benefit from that. So if you're trying to target the poor who receive, who don't have an income because are typically unemployed, then having a tax cut doesn't help them at all. So what the helicopter money approach was basically saying is give everyone, say, $10,000, let them spend it. Now, the whole principle of this, Mustafa, and I suspect you're maybe perhaps a bit more of a geek on this than I am, is that super low interest rates that have been around for a long time, certainly since the financial crisis, but I would argue even before. I mean, interest rates peaked in 1982. Paul Volcker came in and inherited a huge inflation in America due to a series of currency devaluations put into finance the Vietnam War, amongst other things. Volcker then used monetary policy to crush inflation from double digits. And what we saw is that there became this infatuation with central bankers as being the masters of the universe that used the levers to control inflation using interest rates. But then what we saw in 2008 is as they cut interest rates, the economy was still tanking. So that's when they had to come out with things like quantitative easing. And it didn't work immediately. So if you put the stimulus in, it normally takes a little while, traction, people need to get confidence, and they start borrowing money to invest properly, and that's what creates GDP. What modern monetary theory is basically saying is that interest rates are going to stay really low for a really long time. So if you've got a project that can yield, say, a 3% return, but you can borrow at, say, 1, then actually you're making 2. And in making 2, you're helping the economy really prosper. And I suspect you could look at it like that. My only worry about that is MMT assumes that you can dump as much money into the financial system without those interest rates picking up. And if you borrow today at, say, 1 for a project that can make 3, what happens if interest rates go to 4? Suddenly your borrowing costs are at 4, but you're only making 3. So MMT, I think, has got, was a neat solution for a time of disinflation, deflationary conditions. But as I think we've tried to get across today, the theme of the moment is certainly inflation, and I think inflation undermines MMT. Also don't think we need it at the moment.
Lovely. Thanks for that comprehensive answer, Marcus. So that kind of takes us to time then. It's 11 o'clock. So I'd just like to say thank you so much. We've really enjoyed the session this morning. Thank you for your interaction. It's really great to be part of the SME Club and the Pro Manchester revolution within Manchester. And we all look forward to seeing you soon, hopefully in person at one of the next events. Thanks very much.
Thank you.